Welcome back to Everything Money. In this video, you will learn about the financials behind NVIDIA. We will translate these financials from our Everything Money software. You'll see them. We'll show you what you should be paying for this stock using our stock analyzer tool. That's sort of confusing, so stay tuned. If you're interested in trading this company, which is going off the rails of late, you can trade this with Mo. He'll show you the charts. He'll show you the trends if you want to trade this at a quicker pace. We will do all of this coming up. Why should you watch this video and listen to us? Well, I bring your normal person questions about NVIDIA to a couple of wealthy guys who manage over $100 million in offshore boat racing, Benihana additions. No, I'm kidding. In real estate, stocks, and bonds. And we'll talk about this chip maker right now. I present to you Paul Gabriel in all of his glory. Go ahead, Paul.
Hey guys, so first off, follow us on Instagram.
Yes.
New Everything Money account, and then follow us personally so that we don't feel ignored. So guys, is our Everything Money software. We're gonna go to the 8 pillars tool. We're gonna type in NVIDIA. And here is the data. Oh, look at this chart. Look at this 10-year chart. Oh my God. The stock was selling for $4 in 2011. It's at $311 now.
Yeah, I love, folks, if you're at home, see how this normal, beautiful little chart's just humming right along, and then bam, here comes COVID, and we're just exploding like 100x through the roof. So there you go, Paul.
So before anybody thinks that 20 years from now the stock couldn't be lower, let me remind everybody of Intel and Cisco. So Intel was the stock of 2000. It was the most amazing thing in the world. And look, we haven't even hit the 2000 number yet.
What's the market cap of Intel, by the way?
$207 billion. NVIDIA is $780 billion.
We read an article, Paul, from early 2000 about how that was going to be a $1 trillion stock 20 years ago. It's never even gotten close.
Not even close. So guys, NVIDIA, $776 billion company. Our very first pillar. We want the 5-year PE ratio to be under 22.5. Remember, not the 1 year, the 5-year.
Good boy.
It is 196.
Ain't nobody got time for that.
That is an X.
Not
The
under
1-year
20.
PE is 110.
Yay.
Exactly. Pillar number 2, we want the return on invested capital over the last 5 years to be over 9%. Check mark. It's 14.8%. So this company does a great job of investing the capital that is in the business, making money off the capital that's been invested in the business. Now let's look at their dividend yield. Seth, what would you call this dividend yield?
Well, as Uncle Paul would tell us, it's just adorable.
Adorable. 0.1% dividend yield, $400 million. Now remember, guys, dividends aren't always safe. In our software right here, we make it easy for you. We put the free cash flow above to see the dividend's actually safe. They pay out $400 million in dividends, and their 5-year average free cash flow is $4 billion. They pay out 10% of their free cash flow in dividends. They Gucci. Pillar number 3, guys, we want to look at the income statement. We're going to look at revenue growth over the last 5 years. All we want to do is see growth. I don't care how much growth. I want to see some growth. 8.34 to 22.
That's some.
Now, I will say this, Seth. 8.34, 11.9, 10, 13, 21.9.
Yep.
What does that tell? Initially, that makes me go, remember, guys, I don't do research ahead. For all those people out there who claim that doing research about the company is important first, they're wrong. These numbers will tell me a story that I'll go look into. This is a big jump. Now, granted, chips have jumped up a lot last year, but I got to think there's been some sort of acquisitions along the way. So on the cash flow statement, you can look at the acquisitions and dispositions and see if, because we want growth that's happening not just because of acquisitions, but still we have a check mark. Pillar number 4.
Profit growth over the past 5 years.
We just scroll down a little bit on our income statement. We got on a profit, net income, 2.3 to 7 billion.
Yikes.
Check mark there.
But look at before that, Paul. 2, 4, 3, 3.
Yep.
And then 7. Good Lord.
Guys, pillar number 5 is the silent killer and one of the most important ones. It's our shares outstanding. We want to see shares outstanding decreasing. Now, I will say, with such an expensive stock, I don't blame them if they're issuing more shares, because what they're doing is they're the crack dealer on the corner who realizes everybody loves crack and doesn't realize how much it's hurting them. They don't realize, the NVIDIA's sitting there going like, wait, all these people want our stock, even though it's massively expensive. Let's just give them what they want. So we scrolled to the bottom of the income statement. 2.39 billion, 2.49. That's an X, but it's exactly what I expected. Guys, I'm actually surprised it's not higher, because why? If this company wants to raise capital, they shouldn't take on debt. They should issue crack to the addicted crack people on the streets. That's what they're doing here. So,
or in their mansions.
Or in their mansion. You're right. Well, cocaine's more of a mansion kind of drug. Let's be
By
honest.
the way, you have a little snow on your
I only thought there was something on my nose.
Pillar number 6, Paul, involves their debt, baby.
So guys, debt's important in any company. We want to look at debt and say, can this company stick around if there's a recession? Just like you personally, the more debt you have, the less safe you're going to be in your financial future. Same thing with a company. So what do? We have our main page here. I go to the 5-year average free cash flow number. I multiply 4 billion times 5 for a total of $20 billion. I want the total long-term liabilities in this company to be under $20 billion. So how do I find that? I go to the balance sheet on our software right here. I scroll to the very, very bottom. Long-term liabilities, 13 billion, check mark there.
Nice.
Great.
Pillar number 7 is free cash flow growth. We want their free cash growing. I'm certain it is, Paul, wouldn't you think?
I would imagine so as well. Free cash flow is cash from operations less your capital expenditures. You can use free cash flow to do one of 5 things: buy back shares, pay dividends, pay down debt, make acquisitions, and reinvest back in your company. Okay? This is the real true lifeblood of the company. So on the cash flow statement, I make it easy for everybody. I added this line right here because cash from operations less your capital expenditures. 5 years ago, 1.94. Last year, 6.67. Check mark. Our final 8th pillar, we take the average of the last 5 years free cash flow, we multiply it by a multiple of 20 as a starting point to give us a market cap if we want to pay for the company.
This is going to get ugly.
Very ugly. 4 billion times 20 is $80 billion. The company is 776, massive X. Does this mean you don't buy the company? No.
Yes. Oh.
Well,
10X over.
I agree. But remember, guys, for other companies, a faster growing company should get a higher multiple. We put 20 because we need to put something into our software. And guess what, guys? By the way, guess what? Really quick. Remember I talked about acquisitions on the cash flow statement? They made a $7 billion acquisition 2 years ago and 1.3. That's why their revenue jumped. But back to it. Let's go to the 8 pillars tab. You thought that was a lot of work before? We do the 8 pillars for you right here on the 8 pillars tab. PE ratio, and this isn't bothering me as much because they're just selling crack to people who love it. Massively overpriced, guys. Massively overpriced. The one thing I do like, Seth, their free cash flow numbers and multiples and earnings are very similar. Okay, so this is just an expensive stock. We're going to use our stock analyzer tool next to show what you should pay for the stock. It's going to be bad, guys.
If you are at a party and someone brings up this company about chips, you can open up your phone, the Everything Money app, and Paul will show you what you get by joining our software.
So, guys, this software was created because our users said, hey, how do I go do my own analysis without waiting for you guys to make videos? So we made the software. First thing you get is everything you saw here, plus our stock analyzer tool, plus all the things coming soon. And your price doesn't go up when these things come out. It stays the same. Whatever price you lock into is what you get today. Comes on your mobile phone. All of that stuff on your mobile phone. You get access to Seth, Mo, and I, and you get 2 or 3 videos a day of exclusive content just for you guys. And best of all, you get a chat with over 6,000 people who already belong to the software. You can talk to about your investment ideas. So if you're stuck on an island, you don't know who to talk to about your investment ideas like we were, this community makes it feel like you could have these conversations going. And it's only 90 cents per day for all of this, including the stock analyzer tool. 90 cents a day. You're locked in forever. This is a no-brainer, guys. If you're serious about your financial future and want to just earn 1 or 2% more that you could, or save 1 or 2% on losses, this will pay for itself many times over. You can make hundreds of thousands, if not millions. 2 ways to sign up, everythingmoney.com or Patreon. The benefit of our website directly is you don't get double charged the first month, and you don't pay sales tax yet because we're not big enough. So go sign up right now. Let's go to
stock analyzer. So what we'll show you is if you see a lot of comments about NVIDIA out there where people say, you know, anything under 350 I'm buying or anything under 320, it seems arbitrary. What we'd like to show you is the stock analyzer tool helps you determine, use assumptions moving forward for the future and see what we should be paying this to get a return. Paul, walk you through it right now.
So guys, the first thing I did was select analysis number of years, 7. Then I can pick number of assumptions. It's such a big company, I'm just doing 2. Now here's the deal, guys. We show all the numbers here that matter. Revenue growth, profit margin, free cash flow margin, PE, and desired return. I'm going to look at the 10-year, but remember, when you're doing this analysis, I'm not going to assume acquisitions. So a lot of this growth was because of acquisitions. So I'm actually going to go very low on my revenue growth numbers. I'm going to go 4 and 8%. Much lower than the 10-year numbers.
Yeah, you're going to
Mo, what do you think?
You're going to get killed.
Well, not necessarily.
No, in the comments.
Oh, well, yeah, but I'm going to get killed in the comments.
No, but I do agree with you. I mean, I looked through their acquisitions that they made recently. They acquire a lot of companies.
Yeah, and you can't include that as part of growth. You know what I mean?
That's the growth that we're seeing. A lot of the growth that we're seeing.
Yeah, I look at it saying, if this company stopped acquiring, how would they grow? Because I'm buying that business.
Right.
Next thing is profit margin. Now, profit margin is probably going to stay pretty
Yeah,
consistent.
it should.
I'm still going to go 24 and 28%. Free cash flow margin, I like to stay, if I can stay the exact same free cash flow and profit margin, I will. So I'm going to do that here. PE, this is where everybody's going to hate me. Guys, the PE and the free cash flow numbers are so different right now that you're going to be like, Paul, you're just being, guys, this is like saying, hey, you want to buy my house? It's $100 million. Oh, no? Okay, I'll sell it to you for $10 million. It's 90% discount. Therefore, it's a good deal. Well, if the house is only worth $1 million, $10 million is still too much, even if it's 90% reduction in the price. Same thing here. This is just priced really, really high. Over long periods of time, this is not going to be a 100 times PE company. The bigger the company, the slower the growth, the less PE should be there. Okay? Do you agree with me? I don't know. You probably don't. You're going to get comments below saying, this guy has no idea what I'm talking about. Just turn the video off. I don't want to hear your comments. I don't want to hear your comments.
I think that's reasonable.
I'm too busy flirting with your mom on Snapchat as she slides into my DMs
Yes.
and sends me pictures of her. Just go away. I don't want to hear from you. I hit the analyze button. 311 is the current stock price. Any guesses here, folks?
Slides into your DMs. Well,
Close to $100 a share.
Oh, I think it's lower than that.
Oh no, where are we at? 80?
I'm going to say
80 to
40
100?
to 50, $40 to $60 a share.
All right, do it.
let's see.
Oh,
What does it say?
30 to 50.
Oh, okay.
Okay. And by the way, based on that PE, it makes sense because the PE has to fall by 85%.
Yeah.
Stock has to fall by 85%. 15% of 311 is $47, roughly.
Let me translate some of this gibberish. If you buy at 300 and they keep doing what they're doing with these assumptions, you're not going to make much money, but you have to buy at $50 to get that return. So you don't have to buy this, Paul, but show them some of the, what should you be paying? What can you expect if you pay today?
Let's do this. If we put 0% return, we want to make no money. The stock is still only worth between 60 and $100. That means in 10 years, they think it's going to be worth, the stock on the high side should be $100, low side 60. What if you want to lose money? Negative 5%.
That's nice. It's just math.
Okay. So guys, based on this number right now and my assumptions, I'm going to go to losing 15%. Still not there yet. So guys, if you buy this company, and guess what? You might sit there and say, well, Paul, your assumptions are wrong. Okay. Let's go back to 12.5%.
Put the revenue at something.
Let's go to 15 and 20% revenue growth.
Perfect.
15 and 20% revenue growth. It's still an insanely overpriced company. And you're going to argue with me about that PE. Just like that idiot in California who ran for governor who said Tesla's PE is the largest company in the world with $3 trillion in revenue should be 70. You're just going to lose a lot of money.
Put in a 30 and 40 PE. See what it does.
I'll one up you. I'm going to go 40 and 60.
Yeah, 60 PE. This is this is a new day, Paul.
Still
All right,
too expensive.
there you go.
Oh boy.
Ain't nobody got time
If
for
this
that.
makes sense to you guys, you should join our community. If it doesn't make sense to you, you should take your money out into a can and burn it because you have no idea what numbers are. It's just math, guys. Every
just
investment's a
math.
present value, future cash flow. Now, the good news is Mo does charts. Doesn't matter what the fundamentals are. All you're looking at is the charts and the movements of the stock. Mo, show everybody if it's going to work.
Take it away.
So right now, this company has had an incredible run up in the past couple of weeks, last month, because of everything that's happening with themselves and with them joining on to Meta. So this to me is a flagpole, and I'm gonna really zoom in here and show you even more so than the flagpole. If you look at this flagpole pattern, you have these wicks that just keep happening even today. This indicates to me that this thing is coming right back down to where it came from, and I think that level is around the 260 to, what is this? Oh, 230. What I would rather tell you to do, instead of doing this from a long-term perspective, look at it from a swing trading perspective. So this is a day-to-day chart where you can go and make money and catch different trends. You could have caught all of this run and known you're getting to a point with declining volume, you're about to roll over here, and this is probably when you start taking your profits. And if you want to, learn how to short it all the way back down to that 220, 230 level. So this is what you need to do on a company like this to make money. You can make money going long and short on a company like NVIDIA. You don't need to sit in it for multiple years and just hope to God that it goes up, because more likely than not, it probably won't based on its fundamentals. So charts are where it's at if you're trading a crazy company like this.
If you're drawn to this and this resonates and you want to be a value investor, stay away from NVIDIA at the moment. The chart is obvious. If you want to trade it, you can get after it with Mo. Fondle thumbs up. Thanks for joining us. We'll see you next video.